Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Last week we looked at Amazon's business model, the top 5 risk factors, and the contingent liabilities. This week we will be reviewing Amazon's fundamentals. We'll be focusing on the key ratios and performing the DCF analysis as well as an expected rate of return calculation on Amazon to get a better idea of what the intrinsic value of Amazon is and how it pairs out to the current valuations and the current market price of Amazon. So let's dive in and look at the fundamentals for Amazon.
Hey guys, let's start our fundamental analysis by first looking at the 3 segments that Amazon reports its revenues in. The first is the North American segment. This consists of retail sales of consumer products and subscriptions, specifically focused in North America. The second is the international segment, which is just like the North American segment, except it's focused on the international stores. And the last is the Amazon Web Services, the AWS segment, which consists of global sales of compute, storage, database, and other service offerings for startup, enterprises, government agencies, and academic institutions. Over here, Amazon shows us the numbers associated with each segment. We can see that the AWS segment has the largest operating profit margin of 26%. This is derived by looking at the operating income and dividing that number by the net sales. For the North American segment, the operating profit margin is only at a 4%. As we can see, the operating expenses take up a large chunk of the net sales. In the international segment, we can see that Amazon has been generating a negative number, so it's a loss for the past 3 years. This goes to show that Amazon is still trying to venture out in those international markets, and they're willing to take a loss as long as they can emerge as the dominant player. Over here, at the end, Amazon shows us the consolidated numbers, and these are the numbers that we'll be focusing on when we go to Morningstar to look at the key ratios. So let's dive in and go to Morningstar. Hey guys, so now we're on Morningstar for Amazon under key ratios. We can see that the revenue for the past 10 years has been increasing, which is what we want to see. The net income has also been increasing. It has a positive trend to it, except in year 2012 and 2014 when we had a negative years. But as far as the trend goes, it is upward facing. The shares outstanding has been increasing over the years. Back in 2010, Amazon had 456 million shares outstanding as compared to the trailing 12 months when the shares outstanding have increased to 507 million. This shows that Amazon has been doing some equity financing on the side. The book value per share has also been increasing over the years. Back in 2010, it was at 15, and now it's at 147. The free cash flow has also been increasing every year, except we saw a couple bumps or declines in 2012 and 2014. It has been upward facing. Just a reminder, we will be using the 10-year period that we see right here for our expected rate of return calculation. And we'll be using this $26,957 million number for our DCF analysis. Next, we'll look at the profitability. We can see that for the return on equity, 2012 and 2014 were the 2 years when it was negative. But other than that, it has been positive. I think if Warren Buffett were to look at the return on equity, he would have probably put Amazon out of the hat because it's not showing us at least an 8% return on equity for the past 10 years. It has been positive for the most part, but we can see that they were negative for a couple of years. For a couple of years, it was less than 8. So it definitely is something that a value investor would not venture into. But given the potential that Amazon has for the future with the e-commerce and the AWS business, you might want to look at the future than looking at the past. The return on invested capital is a number that's important to look at given that Amazon does not pay any dividend. So this tells us how efficient the management, how efficient Jeff Bezos is at investing the capital and generating a return on it. And for the trailing 12 months, it was at a 10.65% of return on the capital that Bezos invested, which is much superior to, let's say, if Amazon were to pay you a dividend and you're just holding it as cash. So compared to cash, definitely a better return. Bezos is doing a good job at giving you a 10.65% return on the investment. For the financial health, we can see that the current ratio has been positive and greater than 1 every year for the past 10 years. As long as the number is greater than a 1, it tells us that the company has more current assets than its current liabilities. The financial leverage has hovered between a 2 and a 5. Right now, it's sitting at a 3.5. The debt to equity has gone up and down, but it is fairly manageable at a 1.03. It just tells us what's the ratio of the total debt that the company has to the shareholders' equity, which is the amount of money that you and I have in the company. As far as the efficiency goes, the days on the inventory back in 2010 was at about 37 days. Right now, the trailing 12 months has 29 days. So it looks like Amazon has gone better at selling things as the time spent in the inventory for a product has gone down. And that's evident when we look at the inventory turnover ratio as well. Back in 2010, it was at about a 9, and right now it's at about 12.5. So now the inventory goes through 12 times as compared to 10 years ago when it went through only 9 times. Let's quickly look at the current valuations. We can see that the price to earnings ratio for Amazon is at 126 as compared to the S&P 500, which is the top 500 companies in the United States, is at a 25. The price to book is at a 22 compared to the S&P, which is at 3.5. The price to sales at 5.2 as compared to S&P of 2.4. And the price to cash flow of 32.5 as compared to S&P of 14.5. There is no dividend yield for Amazon because it does not pay any dividends. As we can see, Amazon is clearly overvalued as compared to the S&P 500. We're clearly paying a premium when we buy Amazon at the current valuations of $3,300. Okay guys, let's look at the discounted free cash flow analysis, DCF analysis. For the current free cash flow, I'm using $26,957 million. This is for the trailing 12 months. The annual growth rate of free cash flow, I'm assuming, is going to be at 15%. The discount rate at 12%. 3% of long-term growth rate. 507 million shares outstanding. This is as of 2020. And the long-term debt of $23,414 million. I got this number from the liabilities section in the balance sheet. And after taking all of this into account, my intrinsic value comes out to $1,384. The way the discounted free cash flow DCF analysis works is I sum up what my discounted free cash flows would be 10 years out. So my first year, second year, third year, 10 years out, sum it back to today, and then assume that the number would grow, the company would grow into perpetuity, and then I discount all of that to today. And then I add those two numbers up, the DCF for the next 10 years and the DCF into perpetuity, and I get $727,266 million. I subtract my long-term debt from this number and divide it by my shares outstanding, and I get $1,385 per share as my intrinsic value. So now that we know what the intrinsic value is for Amazon, let's look at what the expected rate of return for Amazon would be if we were to invest in Amazon at the current stock price of about $3,300. Hey guys, let's look at the expected rate of return calculation now. I inputted the 10-year history of the free cash flow that I got from Morningstar. And this is the graph that we come up with when we graph free cash flow versus time. As we can see, over the years, the free cash flow has been increasing. So now for the future data and predictions, I'm assuming that there's a 25% probability that Amazon's free cash flow will grow at 25%. There's a 70% probability, which is the most likely scenario, that Amazon's free cash flow will grow at 5%. And there's a 5% probability that it'll have a negative 1% annual free cash flow growth. This is the potential free cash flow array. We can see the 3 scenarios that I just said and the probabilities associated with that. And I then input the numbers of shares outstanding, the current market price of about $3,300, and my expected rate of return if I were to purchase a share of Amazon at $3,300 is at a 0.2%. So it is not a good expected rate of return. Now, if we were to input 1,300 here, which is close to the DCF intrinsic value that we got from our DCF analysis, we get its expected rate of return of 5.5%, which is much superior to the close to 0% return that we were getting at $3,300. And as a value investors, we would of course buy at a level that's a little below the intrinsic value. That way we have a greater margin of safety. So if I were to make a choice of when to buy Amazon, it would most likely be about $900. That way I have a $400 margin of safety, in which case I would be getting about an 8.5% return. However, at the current stock price of about $3,300, we're getting close to 0% return. So today we looked at the three segments that Amazon operates in. We looked at the key ratios. We also looked at the valuations and performed a DCF, discounted free cash flow analysis on Amazon, and found that the intrinsic value of Amazon is about $1,300. We also did an expected rate of return calculation where we saw that at the current valuation, if we were to invest in Amazon at $3,300, we would be getting about a 0% return on our investment. So taking all of that into account, at the elevated price level that Amazon is, as a value investor, I would not purchase Amazon at these levels. It's not to say that Amazon stock would not go any higher. It could very well go to $5,000, $6,000. As Warren Buffett says, there are only two rules to investing. First, don't lose money. And second, don't forget rule one. So at the current valuations, I don't have the margin of safety that I require that would make sure that I don't lose money. So it would keep me away from investing in Amazon.
Hey guys, that is all I had for you this week. We reviewed Amazon's fundamentals. We looked at the key ratios. We performed a DCF analysis and also looked at the expected rate of return of if you were to invest in Amazon at the current valuations, what kind of returns you may be getting. Hopefully you found this video helpful. Please do like, share, and subscribe, and I truly appreciate your time. Thank you.